All right, welcome everybody. Shane Carter here with Eddie Austin from Hampshire Capital, and we are going to run you through our newest investment offering, which is Villas del Zocalo, 206 units in Dallas, Texas. So here's a little bit about the investment offering disclosure. Go ahead and click pause on the video if you want to read through this. Just standard legal stuff we have to put in here. Here's the agenda. Here's what we'll be going through in the offering today, and starts off with sponsor overview. So we at Hampshire Capital have over 50 years of collective experience in buying and operating multifamily properties throughout the country. You can see a listing of some of our assets there. The one Eddie just referred to is at the bottom, landing at McCallum, that we bought last year. So we're just shy of about 2,000 units right now. And we'll be, about 2,200 units once we acquire Zocalo here that we're talking about today. So this is a little bit about me. I'm the CEO of Hampshire Capital. I've done about $305 million in multifamily deals, another $110 million in development and construction. That's my background is really in real estate development and construction. My business partner, Nick Bouquet, he's been in multifamily since 2007. He's done about 20 properties, about 3,500 units. He was mostly on the LIHTC or affordable side of the business. Joined forces with me a few years ago to start Hampshire Capital, and we're off and running now. This guy right here, you may know, Eddie Austin. He's our VP of Operations and Business here at Hampshire Capital. He's got about 18 years of experience in real estate, business management, and entrepreneurship. He's also handles the VP of Investor Relations here at Hampshire Capital, and is also part of our co-fund manager on our newly released Hampshire Multifamily Diversified Fund that we'll be launching next month.
Stay tuned for that webinar coming up soon too.
That's right. This is Sean Hedden, our construction manager. He's a Texas-based employee. He's got 15 years of active construction management, facility management experience, and he's just an absolute rock star. Amazing at what he does. Licensed plumber, all the trades, HVAC, electrical, etc. He's just a wealth of knowledge, and he managed all of our day-to-day activities on site at all of our renovation projects in Texas. So here is the investment introduction. It's a 1984 asset, 206 units, and it is in the Northwest Dallas Bachman neighborhood submarket, one of the top performing submarkets in 23 for rent growth and occupancy. So we got this deal through one of our brokerage relationships with Northmark. We closed our last deal with them as well last year in Dallas. And we're so excited about being able to get this at an acquisition basis of just over $86,000 a unit, which is a huge discount to current market and replacement cost. And as you'll see coming up in future slides, it's a massive 30+% discount to where properties were trading just in the last 6 to 12 months. Upon acquisition, we are going to implement a strategic value add program. It's going to take about 2.5 years. That's a pretty conservative estimate. So we have this as a 3-year hold period, repositioning the property with higher quality renters, improving curb appeal, and improving the average in-place rents and net operating income by renovating units. So you can see the investment summary here. We're buying it at 17.8, a little over 86,000 a unit. Total basis is about 23.5 with the capex, interest, insurance reserves, tax escrows, etc. We're going to hold it for 3 years. We got a 27.3% IRR, which is really a function of that 3-year time period. Time being an important metric in IRR, which is over a 33% annualized return. Going to get a 2x equity multiple in those 3 years. An average cash on cash yield of 5%. With a 7.4% yield on cost. Important to note here as well is that our LP investors are going to get a 12% preferred return. So even though the asset's only yielding about a 5% cash on cash starting in the second quarter of ownership, we're still protecting our investors by not receiving, the sponsors not receiving a penny of cash flow or any promote until our investors get to a 12% preferred interest rate hurdle, and then having a 70-30 split thereafter. This is just a little bit more information about the asset, the address, and average unit size, year built, 96+% occupied, and the average in-place rent's under $900 a month. The slide's a little bit about the submarket, location, median household incomes. I question this data in terms of getting BLS data updated from CoStar. And over the most inflationary time period we've seen here in the last, 24 months. But the 3 mile radius is certainly, above average in terms of the MSA and our household income. So this particular submarket has a 13.6% rent growth in the last 12 months, and currently has an average occupancy of 94.4%, which we're currently just above that. So this sits right on Webb Chapel Extension. It's a main thoroughfare that goes through the submarket, highly visible, fantastic for our future marketing and leasing efforts. Very close to the I-35 corridor, being able to get north-south in the DFW Metroplex. And also the area is surrounded by a lot of high-quality residential with average median home values that are $924,000. This is a very, very, very nice neighborhood that's just to the east and north of us. Very limited construction supply. There's only 722 units under construction within the 3 mile radius. 422 of these are being built on the south side of Love Airport, where we're on the north side. And the remaining 300 unit is in a different neighborhood in the Northwest Dallas submarket. So there's really nothing in our 1 mile or in our neighborhood that's under construction. There's no units within 2 miles of the property under construction, and because of that, we don't anticipate being subjected to the downside rent pressure from new apartment deliveries and all the concessions and supply issues that they can put on a submarket. So here's our investment thesis. We really like the acquisition basis. We're just about a 10% discount to lower quality, older properties currently under contract in the submarket. We'll show you the details of that in a future slide. And again, we're over 30% discount to sales comps in this neighborhood within the last 6 to 12 months. So we really feel amazing about the basis play here. Now, the deferred maintenance rent upside. The current in-place rents are $215, or just below 20% below the comp average rents at renovated properties in our area, which shows that we have substantial room to increase NOI by doing strategic interior and exterior renovations, repositioning the property really to compete with the market and what our neighboring rent comps are doing in terms of their value add renovation programs. So there are 12 transactions in this neighborhood in 22, most of which have executed interior and exterior value add renovations and have already proven out higher rents in the submarket. So through well-maintained, although this property is well-maintained, it's underperforming due to dated unit interiors, exterior aesthetics, and lack of modern amenities. So this slide just shows us a general overview of our renovation and CapEx plan. So we're going to start renovations in month 3, and we're only going to do about 7 units a month. This is a very low cadence or velocity of renovations. Only 3.6% total, where we're expecting a 5% vacancy rate. So we're not even going to renovate all of the units that turn over on a monthly basis. So this projects that we'll complete renovations in month 31. Of course, we can expedite this and do it faster and achieve revenue growth even faster than we're projecting in our model. But we feel like this is a very, very conservative cadence and velocity to be able to achieve renovated rents on.
And I think with that, also we want to maintain occupancy with this business plan as well. So, by doing this, we're going to be able to maintain occupancy and do renovations at the same time.
That's exactly right, Eddie. Thank you for bringing that up. That's a key point. Is we really want to keep cash flow up. We want to keep occupancy up. We don't want to force any unnatural vacancy at the property in any way.
No.
So our average pro forma rent is about $11.67, and that gets us about $181 a month rental premium. Our total budget for all capex is about a little over $14,000 a unit. About $8,000 of that's going to go in the interior program, and our total ROI for the total budget is about 23%. Now, if we did that analysis just based on the $8,000 a unit, obviously that 23% would be about 40%. But we like to be conservative, and so we based it on the whole thing. So here's what our interior renovation scope looks like. We're going to resurface the counters, kitchens, and baths, put on new cabinet fronts and hardware, kitchens and baths, new vinyl plank flooring throughout, carpets in the bedrooms, only on the first floor, new lighting fixtures throughout, new unit paint throughout, new black stainless appliance packages, and new bathroom vanity and frame mirror. So this is an important slide. This shows us our rent comps, and they're broken out by unit type. So 11S, 11L, 11s, and 22s. And the important thing to note here is that you'll see that our pro forma rents here, right, $1,100 on 11s, is below the comp average currently of $1,226. So we're $126 a month under the average in-place renovated rents at our neighboring properties. Same with the 11Ls. We're even bigger. We're $137 a month under the in-place comp average rents. $133 under on the 11s and $70 under on the 22s. So this is, again, important in that our pro forma rents are underwritten to be less than the average in-place rents at our comps and what they're currently achieving. These are those sales comps we referred to earlier. There's a list of each one of the assets that sold in our neighborhood, the addresses. Now this is important to know. Here's the vintage. 68, 73, 1970, 63, 66. We're 1985 asset, 84 asset. It's the only one here. It really is, Spanish Breeze, right? And that one traded at 116 a door, and we got ours at 86 a door. And so the average sales comp is about 127 a door, which gives us about a 32.2% discount to what things were trading at, again, just 6-12 months ago. And here's some of the ones, again, that are currently under contract, and we're almost a 10% discount to those. And again, these are 10 to 20 years older than us. 1964, 1973. Really feels like a great basis and that we're stepping into fantastic equity on this one. Eddie, you want to run through the investment summary here?
Absolutely. So, a simple investment summary, 100K invested. As stated, this is a 2x multiple. 33.2% average annualized return. We're offering a 12% pref. And as you can see here that we have this advertised that this is a 5% cash on cash, meaning we will accrue. We're going to start renovations on month 3, and in the second quarter of ownership, we anticipate distributions at 5%, and we'll accrue the 12 all the way until 36 months. So $100,000 invested, 2x multiple, have $99,548 in profit. Again, we're doing a 12% preferred return for 3 years. It's a 27% IRR.
That's right. So this is just going through our pro forma here on a 3-year hold. Again, you can pause and study this. We're happy to provide it as well if folks want to go through the Excel. I think some key things to note here is, on this column here, you got the T3, T12 average. This is existing. This is what currently the property is doing, right? This is existing NOI, 891. Year one, our net effective rent is growing. Our effective gross income is growing, but not by much. About $130,000 is about all we're expecting to grow. Whoops. And our NOI again is not not very much. It's about $75,000 a year in NOI growth in our first year. And so obviously we cover our debt service. We got great debt service coverage here, and we've got great cash flow coming off the asset. But again, unfortunately, this is only enough to pay about a 5% cash on cash. Now, as we go through and grow NOI, you can see that we really start getting some more aggressive NOI growths in year 2 and 3. That's because that's when the renovation cadence and the revenue build really starts to hit and really starts to grow. Even though we are growing our expenses, our total expenses obviously are growing on a year-over-year basis. It's really this revenue growth that's driving the NOI growth. And so that's really where this renovation and us being able to achieve the renovations and the rents that our neighboring properties are already achieving. And again, the fact that our rent comps and our business plan projections are to come in under what they're already achieving. We feel like this is sufficiently conservative. We're excited about this opportunity accordingly. Go ahead, Eddie, run them through the offering timeline here.
Yeah, so on the offering timeline, subscriptions are due 10/20. Allocations confirmed by 10/24. Funds are due by 10/27, and we are closing this thing up at 10/31. We are at the closing table. On the contacts here, you can contact Shane Carter. You got his email here and his phone number. You have myself. Again, I am the VP of Investor Relations and the VP of Operations. Please reach out to me. Happy to schedule a call. Happy to run through this and answer any questions that you have. I have my email here and my phone number. And if you are ready to invest, we have our access to our portal right here in the link. Also in this webinar, there'll be a link to the actual portal as well. You can jump straight in, run through the documents, and you'll be able to see the OM again and then run right through it. We run Invest Next as our platform. Very easy to get through. And if you have any trouble at all, please do not hesitate to reach out to me, and I am happy to walk you through it.
That's right. All right. Well, thanks, everybody. We look forward to seeing you in with us on this investment, and we'll talk soon. Appreciate it.